Welcome to RBC's Markets in Motion podcast, recorded February 24th, 2025. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we found more evidence of weakening investor and consumer vibes in last week's data updates, while getting a mostly positive data point on corporate vibes and a flattening in political vibes. Second, the rotation of funds flows from U.S. equities to U.S. bonds and European equities strengthened last week. If you'd like to hear more, here's another 6 minutes. Let's start with takeaway number one, and a quick warning, this one's going to be long. Last week, we saw weakening investor and consumer vibes, a mostly positive data point for corporate vibes, and flattening political vibes. So we've spent a lot of time in our recent client meetings highlighting how several categories of vibes, specifically investors, corporates, and consumers, appeared to be fading or getting dented to varying degrees, while political vibes, i.e. public opinion of the new administration, have been strong, helping to push stock prices higher. The story, though, evolved a bit last week, and here's what we learned. First off, investor vibes continued to weaken. We've been tracking investor vibes a few different ways. One of our favorite ways is net bullishness on U.S. equities in the weekly AAII survey, which is a retail investor survey. In last week's update, the 4-week average on net bulls fell to minus 8.2% after the weekly data point came in at minus 11.3%. With this move, the 4-week average is now nearly one standard deviation below the long-term average, a level last seen in November 2023 at the end of a 10% drawdown in the S&P 500, alongside a big surge in the 10-year Treasury yield. We spent some time last week exploring whether this survey data tells us anything about where U.S. equity funds flows are headed. What we found is that bearish AAII sentiment is usually accompanied by weak U.S. equity inflows or outright outflows. U.S. equity flows have been positive in early 2025, but weakening in terms of trend. And what we're seeing on the survey tells us that U.S. equity flows are at risk of turning negative. Other data points that highlight the recent weakening of investor vibes include the move lower in U.S. equity futures positioning for all of the major contracts we're tracking on the CFTC data, recent moves higher in the VIX, RVX, and TDEX, and the stall in Bitcoin, which up until very recently had been tracking the S&P 500 rather closely again. Another data point worth taking note of, the widely followed Citi U.S. Economic Surprise Index did turn negative for the first time in over a year last week. The second vibe, we saw additional evidence of weakening consumer vibes last week. As our regular readers are well aware, we keep a close eye on the University of Michigan Consumer Sentiment Survey, given the fairly close relationship it's had with S&P and Russell 2000 performance year over year since COVID. Last week, the survey released its final reading for February, which came in below expectations and below the prior month, at a level that makes it appear to us that the recovery in consumer sentiment that's been underway since the recession-like lows of 2022 has been broken. The decline in sentiment was felt across a number of key cohorts, including income and education. In terms of partisanship, declines were seen for Democrats and independents, but Republicans were essentially flat. The report also identified a second consecutive month of heightened inflation expectations as one source of consumer angst. This report comes on the heels of a disappointing retail sales report the prior week, disappointing guidance from a retail bellwether last week, and an S&P 500 reporting season that hasn't, at least so far, provided much insight into the current state of the consumer today, other than to briefly allude to well-known themes from the past year of resilience, divergence between low and high-end, choicefulness, and ongoing pressure from high interest rates and prices, as well as a preference for experiences. We're looking forward to seeing what the Conference Board Consumer Confidence Survey due out this week, and the many consumer companies expected to report earnings have to say on the current state of the consumer. We hope that they will shed more light on recent trends. Third on the vibes, and this one's positive, we got a mostly positive data point on the state of corporate vibes last week. Specifically, this came from the Conference Board CEO Confidence Survey, which was sharply above 4Q24 levels. Improving sentiment was seen for both the broader economy and the participants' own industry. The survey was conducted from January 27th through February 10th, giving us a fairly current snapshot of corporate sentiment and how it compares to last November. Some of the details in the survey were interesting in light of questions we've been getting from clients about how current policy uncertainty may impact C-suite behavior. Most of the participants said their CapEx plans were unchanged, with a small uptick in those who were more bullish on CapEx. 41% also said they had no plans to change their employment levels, but we did see a downtick in the percent who said that they would ramp up employment. In our recent earnings transcript recaps, we've noted that C-suite optimism has been dented by policy uncertainty. The results of the Conference Board survey lend support to the idea that the optimism, while it may have been dented, hasn't been derailed. We are continuing to keep a close eye on corporate vibes, however, and note that the survey data released by the Philly Fed last week did point to downticks on CapEx expectations among their survey participants. Fourth on the vibes, political vibes have flattened out. In our meetings, we've been highlighting how the president's net favorability in public opinion polls had turned positive recently and become correlated to S&P 500 performance, similar to how his polling data as a candidate had been trending with S&P pricing last year and even back in 2023. We've also noted that views on the direction of the country had rebounded sharply in public opinion surveys. In recent updates, however, we've seen net favorability turn slightly negative again, and the improvement in views on the direction of the country have also flattened out, though both admittedly remain at much stronger levels than seen a few months ago. The major stock market indices in the U.S. fell sharply on Friday, with a whole bunch of reasons cited. We've been of the opinion that the stock market's been overdue for a 5 to 10% pullback, and the general weakening, denting, and flattening of the vibes that were expected to be strong in 2025 helps us understand why a pullback may be finally getting started. Now, we'll wrap up quickly with takeaway number 2, the rotation in flows that's underway. As noted earlier, flows to U.S. equity funds have continued to deteriorate in the latest EPFR updates. Meanwhile, flows to U.S. bond flows have continued to surge. We've been highlighting these two trends, along with less onerous outflows from Western European equity funds and German equity funds in recent weeks, as possible signs of asset allocation out of U.S. equities into bonds and some segments of European equities. The idea that we're seeing rotation from U.S. to Europe did gain some support in last week's EPFR updates, which indicated that flows to Western European and German equity funds have finally turned positive. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.